Your last car payment is not just the finish line. It is a decision point. Once that balance hits zero, that payment can either start working for you or quietly disappear into spending, upgrades, or another loan. This video may change how you think about car payments. Subscribe and turn on notifications for clear finance breakdowns. Section 1. The zero balance moment. Imagine Derek. He's 38, lives in Ohio, works in logistics, and for 6 years, one number followed him every month: his car payment. Every paycheck, that money was already gone. Groceries could rise, insurance could jump, the kids could need something unexpected. The lender still got paid. Then one morning, Derek logs into the loan portal and sees it. Balance, zero. No payment due, no payoff quote, just zero. For a minute, it feels amazing. He refreshes the page twice because it almost does not feel real. But this is where the real test begins. Most people think the victory is paying off the car. The bigger victory is what happens after, because that payment did not disappear. It became available. And if Derek does not give that money a clear purpose, everyday spending can absorb it. Section 2. America's car payment reality. The New York Fed reported auto loan balances at about $1.66 trillion in Q4 2025. Experian reported that the average new vehicle payment reached $767 per month in Q4 2025, with the average new loan amount at $43,582 and an average interest rate of 6.37%. That is not a small payment. For many households, it is a serious monthly commitment. And that monthly number is where many buyers get stuck. A dealership conversation often starts with, "What monthly payment are you comfortable with?" Not, "What total price makes sense?" That changes the way people think. Can I handle $650? Can I stretch to $750? Can they get it under $700? Suddenly, the focus is not the total cost. It is the monthly feeling. Section 3. The next loan cycle. After payoff, the freed up money feels like breathing room. Derek goes out more, upgrades his phone, catches up on things he delayed. Nothing feels extreme. It feels deserved. Then the car starts feeling old. The screen looks outdated. A neighbor buys something newer. One repair estimate hits $900, and Derek thinks, maybe it's time. That thought can get expensive fast. Edmunds reported that in Q1 2026, 30.9% of trade-ins toward new vehicle purchases had negative equity. Buyers who rolled negative equity into a new loan had an average monthly payment of $932. That is how some people finish one car payment and quickly start a bigger one. The car was paid off. The payment habit was not. Section 4. The long-term opportunity. Now look at the math Derek may never see at the dealership. If his old payment was $767 and he keeps driving the paid-off car, he has a choice. He can let the money melt into spending or automate it towards savings, debt payoff, retirement, or long-term investing. At a hypothetical 7% annual return, $767 per month for 30 years could grow to about $936,000 before taxes, fees, and inflation. At a hypothetical 10% annual return, it could grow to about $1.73 million. Not guaranteed, not instant, not financial advice. Just a simple example of time plus consistency. Derek does not need a raise to start. He was already making the payment. The idea is simple. If the car still fits your needs, you can redirect that old payment toward your future goals. Section 5. The mental relief. Paying off debt does not just change your budget, it can change how life feels. Debt creates mental noise. When the car loan is gone, one monthly obligation disappears. Sometimes progress feels like sleeping better because one automatic payment finally stopped. If this is helpful, tap like so more people can rethink their car payment. Section 6. The insurance review. Here's another move many people miss. When you have a car loan, the lender usually requires full coverage, but after payoff, you have more flexibility. Bankrate reports that average full coverage car insurance costs about $2,697 per year, while minimum coverage averages about $820 per year. That does not mean everyone should drop full coverage. If replacing the car would be difficult, full coverage may still make sense. But the policy should be reviewed. If Derek's car is worth $7,000 and he is paying a lot for collision and comprehensive coverage, he should compare the cost with the car's value. A middle path could be raising the deductible, shopping rates, or keeping comprehensive while dropping collision. Do not keep paying lender-level insurance after the lender is gone without checking the numbers. Section 7. Your car may have more life left. Many people replace cars too early because they assume older means unreliable. But modern vehicles are lasting longer. S&P Global Mobility reported that the average age of U.S. light vehicles reached 12.8 years in 2025. So Derek's 6-year-old car may still have years left. A repair bill is not always proof that you need a new car. A $1,200 repair can feel painful, but it is not the same as signing up for another $767 monthly payment for years. One is a bill. The other is a long-term commitment. If the car is safe, reliable, and repair costs are reasonable, keeping it can be a strong financial move. Section 8. The paid-off car plan. Here's a simple educational framework. First, consider automating part or all of the old payment. If the car payment used to leave on the 12th, set up a transfer on the 12th. Depending on your situation, it could go towards savings, debt payoff, retirement, or a long-term investment account. Do not let it sit in checking without a job. Second, build a car repair fund. Tires, brakes, batteries, and maintenance are still coming. Third, for viewers carrying high-interest debt, paying it down may be worth considering before taking on more investment risk. Fourth, start an X car fund. Even $150 or $200 a month can become real buying power over time. That can help reduce the chance of restarting the loan cycle. Try not to wait until the car stops running. Prepare while it still runs. Section 9. Freedom looks boring. Here's the hard part. A paid-off car usually does not impress anyone. Nobody claps when Derek pulls into work in the same car. Nobody sees the loan balance at zero. Nobody sees the automatic transfer. But that quiet move can matter more than a newer vehicle in the parking lot. A newer car can look like progress. A paid-off car can help create progress. Those are not always the same. The person with the new payment may look ahead for a moment. The person with the paid-off car may be building options. Options for emergencies, options for career changes, options for less monthly pressure, options for more flexibility. That is what changes after paying off your car loan. Not just your budget, your choices. Paying off your car loan is a big moment, but the real change happens after. Keep driving the car if it is safe and reliable. Review your insurance. Build a repair fund. Redirect the old payment before lifestyle spending absorbs it. Here is the full message. A paid-off car frees a major monthly payment. The next loan cycle can start quickly. Redirecting the payment can support long-term goals. Insurance should be reviewed after payoff. And real freedom often looks boring from the outside. I am curious to hear from you. Would you keep driving a paid-off car for 5 more years? What would you do with your old car payment? Drop your answers in the comments and subscribe for more educational personal finance content. Thanks for watching.